It's now time for your financial matters with Andy Mattingly. A credit score is a concept that most consumers don't fully understand and often don't realize it's used more than just by financial institutions. So Andy from Forum Credit Union is here with us today to break it down, what that credit score really means.
Yeah, Andy, we always see the ads, as I said on Twitter,
Yes.
but what is the real basic definition of a credit score?
Well, a credit score really is just a predictive model. So they take how your payments and you pay your lenders and things like that, and they put together a model to determine how likely you are to pay back credit, how you'll handle certain types of credits, maybe even how likely you are to file insurance claims.
We always hear about FICO, your FICO credit score.
Yes.
Is that the only one?
There are actually several credit scoring models. FICO is the most prevalent one. The thing is, you have to remember there's a score and then there's credit reporting agencies, and a lot of people mix those two together. You have a credit report and you have a credit score, and those are kind of two different things.
Okay, so we see them on the screen. What's a good score?
Well, excellent, 750 and above. If you're in the 650 to 700, you're doing okay. If you're under 600, we have problems. We need to do something about that.
How do they come up with these numbers?
Well, basically, they look at how much debt you have, how you utilize debt. So meaning, like if you have a credit card, how much of it do you have to the limit? How do you make payments? How much new credit you have? How many times you try to get credit? All of those things go into a scoring model.
Okay, so then the question is why? Why do they do this?
Well, basically, the model is used to determine your risk, so how likely and how willing are you to pay back any debt that you would get. And so financial institutions use that to know how much risk they're taking on, what to charge you, how much to give you, those types of things.
There seems to be a lot on the line with that one number, but do lenders ever look at anything else?
Yeah, they really do. They first look at what's the trend. Is your score going up or down? And then they also look at how long you've had credit, because maybe you have a low credit score because you're just starting out, and that's better than someone who's had credit for 10 years and has a low score.
And we know about buying the house, buying the car. What else is this used for?
Well, it can be used in job applications. They may look at that. For service, cell phone companies, cable, they may deny you service if you have a bad score. And then also insurance rating, because how much they're going to charge you for insurance.
Oh, all right. The insurance is very important.
Yes.
So as to not obsess about it, like this isn't something you should be looking at every single day by going online. So how often should someone check their credit score?
Well, and I'm glad that you brought that up, because you should look at your credit report every year. And I said report, not score, because that's where you look to see if there's any fraudulent activity or things like that. And then you should just look at your credit score once a year as well, because it's not going to go up and down a lot. Yeah, so just once a year. But remember, when you get your free credit report, that doesn't come with your score. You need to pay to get your score.
And this builds on the snowball that we always talk about.
Yes.
You can see the wide-ranging effects that it can have if you don't pay your bill.
Absolutely.
All right,
Absolutely.
Andy, where can people find you?
At forumcu.com.
Thank you.